I'm here today with Bob Nolan, who's the managing partner of Halyard Capital. And Bob, really appreciate you taking the time today. As I start all my shows, first I'd like to have you talk a little bit about your life and what it was like growing up as a child.
I come from a large Irish Catholic family. There were 7 of us growing up. I was number 6. And the benefit to being from a large family and being at the tail end of the family is you get to observe all forms of behavior. And the good news with that is you get to pick from all forms of behavior those types that will actually be effective in the rest of your life and those types you'd rather not experience in the rest of your life.
You had all your brothers and your sisters, and you had a great upbringing, and then you had a pretty good college career. Tell us a little bit about that.
Well, I ended up going to Georgetown. 3 of my children have gone to Georgetown and graduated since then. So there is quite a family connection with the school, and I've stayed quite active at Georgetown.
Instead of getting an MBA, you got your law degree?
Yeah, that's sort of an interesting story. Coming out of school in my senior year, I was admitted to Columbia Business School and had sent in my money, full intention of going. Graduation weekend at Georgetown, so when my father arrives, who always had it in his mind that he should have been an attorney, and he arrived with an admissions letter from Fordham Law School. And I had taken the LSATs, but since I'd already decided I was going to attend business school, it was out of my mind. But he convinced me on that graduation weekend that I'd be better served with a law degree. And his whole thesis was that you can use the degree effectively in business just as you can practicing law. So I ended up going to law school, practicing law for 3 years, and then, of course, migrating to investment banking. And I probably ended up exactly where I would have had I gone to business school.
Okay. Now, when you were in school, did you even think about finance at all? You ended up going to Goldman, right?
I did. When I was in school, my undergrad degree was in business, so that did help. In terms of when I was a practicing lawyer, I was working in the securities arena, and so we were working with investment banks. And so it was a natural gravitational pull to someone who had some background in finance, to finding that intriguing, and then in time I just moved over to the investment banking side.
When did you decide to get into private equity?
Well, the way that came about, again, like most of these plans, as much as I'd love to tell you they were 100% finite, they're usually somewhat happenstance. And in this case, I had been approached by a headhunter. I was running a TMT group at CIBC, and it was 1999, and received a call from a headhunting firm regarding setting up an investment banking presence for the Bank of Montreal in New York. And I suggested that we would be interested, but only in working for a merchant banking context. And so lo and behold, we had a long negotiation with them, and they were willing to put up $450 million to the notion of a private equity fund. At the time, TMT was quite in vogue and quite, as you know, attractive as an investment premise. And we went off and became employees of the Bank of Montreal, and then ran Halyard within it, with BMO as the sole limited partner. And then in 2006, spun the group out to an independent status.
In terms of the transition, going from banker to private equity, you talk to a lot of private equity guys, and they're like, well, if I get a banker, you know, he's never done deals. He's never invested. He's put deals together, but he doesn't have sort of that investing acumen. How did you make that leap?
Always the right question. I think when you're acting as an agent, which is an investment banking role, you're always looking for that opportunity to become a principal. You know that you haven't really experienced the full episode unless you've lived it from the principal standpoint. And so we were always thinking about how could we get close to the principal role. Now remember, in investment banking, more so today, you're dealing with so many financial sponsors that you get a glimpse of what it's like to be a principal investor. You still are one step removed. The other issue, of course, is that you don't live the experience beyond the transaction. The investment banker handles the transaction and then moves on to the next opportunity. But obviously an investor lives that opportunity until completion. So the notion is you need to be good at knowing that you're willing to pursue the full opportunity. Some are better transactions and should remain in that capacity. Others are better at understanding a paradigm that begins at inception and ends at completion. And those are the real investors. And I think in our capacity, it came about because it seemed like a natural evolution from where I'd begun. Remember, I started as an attorney. So the foundation was a little bit different. I might add one quick thing. And I would think most investors would agree with this premise. The broader your perspective, the more effective you are as an investor. So the background that you bring should be as broad as possible. will all help a little bit in that regard. Had I only been an investment banker, had I only been exposed to business school, I don't know that that would have been enough. It certainly is in many instances. But I also think undergrad degrees should be as broad as possible. I think the more skills you bring in terms of analytical ability, the better served you are as an investor.
About a year ago, I interviewed Bill Comfort, who is one of the godfathers of private equity going way, way back. And he was like, Skitty, it's easy. It was so easy doing this business. Today, private equity is incredibly competitive. What are your thoughts on that? How do you go about finding deals?
Well, first of all, just to answer the question broadly that Bill Comfort raised, I think private equity is a misnomer. I don't even think the term functions appropriately any longer. Look at the number of public entities that do private equity investing. So the whole notion of being under the radar has long ago left the scene. The way in which you operate is completely different than when Bill Comfort started. I think in terms of sourcing deals, to his question, it's a little bit different for us, right? We're growth stage investors. So what does that mean? That means normally we're investing with an entrepreneur at a stage where they need to institutionalize their practice of their business. And in that regard, we normally source our deals directly because it makes sense. They're seldom represented by large institutions.
Right. Okay. Let me ask you this. In terms of some of the deals you've worked on, because you've worked on a ton. You've worked on them on the banking side. You've worked on the private equity side. What have been some of the deals that are the most notable in your career?
Well, I think of it more about industry, right? So when the internet first came in vogue, and no, Al Gore did not find it. One of the first internet infrastructure players was a company called UUNet. And the founder of UUNet was a gentleman. Well, there are two of them. One was Rick Adams, but the one who became principally the CEO and familiar name was John Sidgmore. And he used to mention that he thought I was lost when I showed up at his office because I was the first investment banker to show up there. Well, it was because it was so novel and so new. He was in Northern Virginia, which was the hotbed, which made sense because, again, of the DARPA's original influence, that I was just completely intrigued that this notion could even function in an outside world. And from there, we took that company anyway. They became an infrastructure layer. We both sold a piece of the company to Microsoft in the early 90s. We took the company public, ultimately sold them to what became WorldCom, which brought its own excitement.
Bob, let me ask you, what are some of the deals that have been the most complex or some of the deals that went south? Because everybody's got deals that went south in their career.
Now you're really touching the sore spot of all investors. Here's what I think is because the real question is, are there common ailments? Of course, everyone's going to answer management. Good management will save the worst of deals, and bad management will sabotage the best of business plans. So there's no question management is always the key element. Now, having said that, there are instances where we got it wrong because the evolution of technology overtook our business, where we just got it wrong, where, as you know, media and content in particular became digitized in a rather rapid fashion. And if you weren't on the right side of that digitization, you could get caught. And it happened to us in one instance that still was painful. As we went to go about obviously spending a great deal of money and time digitizing the content, making sure the platform was proper to the delivery of that content, we just didn't get it right. We didn't get there fast enough, and we didn't have the right people, honestly, to sell the product when we were creating the right product.
Let me ask you right now, in terms of the private equity market in general, do you feel like things are getting pretty toppy?
Well, think about it. Private equity's model requires an 8% compounded rate to be returned to their investors before they're allowed to participate in the carry. Well, if average GDP growth has been in the 2 to 3% range the last few years, think about how much better you have to do than the average growth, right, to exceed 8%. And then, which tells you need to pick not only the right industry, you need to pick the best companies within that industry. And there aren't that many when you have so much money pursuing the hotter areas. So back to your point, the scarcity value gets bid up because there isn't enough general growth in the system. Now, we can all point to industries that are experiencing more growth, and you'll touch on technology, and you'll touch on e-commerce and areas that we could, or energy at the appropriate time. But the reality of that situation is that just brings more attention from more buyers and bids up the frothy levels. So what's the best way to approach that? From our perspective, we've built, and you'll hear this from others, many platform companies. But the real reason is because the only way you can buy effectively in a toppy market is to be a strategic buyer, where you can exert synergies through the acquisition by combining two entities or more. So only way you can average down a multiple. And the multiples right now far exceed the inherent growth in the system. Despite, the comment I just made, or the caveat I just offered regarding certain sectors within the economy. The general economy is not as robust as any of us would like. And so I see the situation as a bit dicey at this level. But if you're in the right arena and you're with the right companies and you have the right management team, you can overcome it. We have companies that are growing quite rapidly. But you're always mindful of the fact that the general economy isn't, that you need to be that much better. And who's always that much better?